The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed. For a full list of current recommendations and stocks owned by staff, members of Intelligent Investor can visit www.intelligentinvestor.com.au.
Welcome to StockTech Q&A. My name's Gaurav Sodhi. Joining me today is analyst Mickey Mordick. Hey, Mickey.
Thanks, Gaurav.
So, Mickey, just a reminder that we have two versions of StockTech. We have the regular StockTech, where we have three of us sitting down and talking in depth and very seriously about stocks. And we have the Q&A version, where people send in questions, we answer them. Often there'll be just two analysts. And I like to think this is a bit more casual, Mickey, which is why you're dressed so appallingly today. Nice one.
Well, I didn't dress up like this for the podcast. This is just my regular terrible outfit. So.
When you think about it, it's pretty strange to dress up for a podcast. You'd have to be a particular kind of individual. But
yet here you are.
Well, I was going to keep it a mystery, but a certain research director of ours does tend to dress up for podcasts, even though there's not a camera in sight. All right, let's get into some questions. A lot's been going on. One of the most consistent questions we've been getting concerns Westpac. We all know what's happened at Westpac has been pretty appalling, pretty surprising, and we won't really comment on the ethics or the ESG of it. But just in terms of the share price, here we have, Mickey, a large business that's well established, operates in an oligopoly, and now is coming into a bit of misfortune. These sound like the sort of ingredients that we typically look for in a buy idea. Is Westpac that yet?
Yeah, I wonder. I mean, it seems to be getting quite close to Nathan's buy price. I'm not sure if that means he'll actually end up upgrading it. But yeah, I mean, in terms of things like this, these kinds of issues, banks tend to kind of run into these things on the regular, basically. So it seems like it's more of just a cost of doing business, and it's just kind of lumpy. But maybe you should be incorporating these kinds of things into your overall assessment of what earnings are going to be, because it seems like every couple of years they just get hit out of nowhere with a new charge. So
and it's been happening overseas as well. The UK banks have been smashed with billions of pounds and of additional charges, and it's been ongoing for about a decade. And I just wonder whether that experience isn't now translating here locally, that this could be a continuation of a trend that goes on for years and years.
Yeah, well, I guess they're just easy targets as well. No one really likes the banks, and it's kind of easy for...
Who doesn't like banks?
But yeah, I mean, they're such huge companies as well. Having the internal systems to actually avoid these kinds of issues must be an absolute nightmare.
Yeah.
And there's so much going on that you've got to assume there's just, there's going to be stuff every year happening, or maybe not every year, but there's always going to be some stuff lurking under the covers that you can't see from the surface.
Now, nominally, Westpac does look attractive. If you look at the yield, I think it's offering sort of, what is it, a 7% yield or so, something around there?
Yeah.
And you got franking on top of that, so it looks attractive. But I would just caution that there is a lot going on here. Westpac now faces the prospect of higher capital charges from the regulator. The regulator has already said that higher capital charges are likely. The New Zealand regulator is demanding more regulatory capital. And the more capital you have to keep aside, the lower your future returns will be. And the lower your future returns, the less cash you have to pay dividends with. I'm starting to wonder, actually, whether these dividends are going to be sustainable. And I'm of the view that they're probably not. They're probably going to be another capital raising if they wish to sustain dividends, or they might turn dividends into a share purchase plan. But I don't think this sort of yield looks sustainable to me if these requests for more capital actually happen. And the bank does itself no favors with these sort of ESG compliance problems that pop up. I think that just annoys the regulators and makes them push for their desired outcome more aggressively. But so yeah, our official reco on Westpac remains hold. It's getting close to its buy price, but I think Nathan will update everyone if it actually breaches or gets closer still. So keep an eye on Westpac and just be a bit skeptical about the raw numbers. I think they can be misleading a little bit. The other big piece of news we've been asked about is the Tyro IPO. Now, Tyro is one of seemingly endless parade of payment companies that's looking to come to market. The last payments company was Latitude, which is a payments company, but also a sort of consumer finance business. Tyro has been a lot more successful. Mickey, have you been following this one?
Oh yeah, a little bit, and I think the gist of it is probably that you can just about pay absolutely anything for this company. It's a payments company,
Yeah.
so
it seems to be the feedback. There are some big names attached to this. I think Regal Funds Management are in there. There's a couple of high-profile fundies already in there, and high-profile individual backers. So the founder of Atlassian, I think he owns 13% of this as well,
Right,
and he's going to maintain that stake. So there are in the investment world, these are celebrities, and they're bringing a really high-profile IPO to market. For me, these are all cautionary tales. I don't like to invest in big celebrity stocks.
I can kind of hear JG's dissenting approval
Yes.
from here already,
The
but I
ghost of JG is nodding disapprovingly.
Yeah. But I guess, as value investors, you can kind of be pretty quick to dismiss these kinds of ideas. But, it's always worth having a look and giving it, paying its dues. And kind of, you never know what you might uncover, I guess.
Well, I'm glad you mentioned that, Mickey, because I did actually have a little look at it, and I don't think we're going to write anything up because this is not really the sort of situation we're interested in getting people into. It's a $1.2 billion business earning not very much in terms of profit, although it's growing quite quickly. But it's an interesting concept, and I think it's worthwhile keeping an eye on in case it has a problem down the track. So Tyro is as we said, it's a payments business. And what it does, it provides payment terminals and software for small business owners, or large business owners for that matter, to accept card payments. And that's actually quite a competitive space. All four big banks do that, and there are a whole host of third parties that do that. SmartPay out of New Zealand is one of the more high-profile hopefuls in that area as well. The difference with Tyro is that its technology is actually a bit more advanced. They accept a whole range of more international payment options. So you can pay with Alipay and I think WePay as well, which you can't do with traditional payment means, and that makes it attractive to a whole host of customers. But one of the big draw cards is that I understand this is one of the first technologies that allows the FPOS transaction to be linked to the point of sales transaction. I don't know if anyone has worked retail, but when I was in university, I did. And at the end of every shift, I had to tally up all the receipts from the sales book and all the receipts from the FPOS book and just kind of cross-match them. That's an exercise that a lot of retail business owners go through manually, or they have to have third-party software to deal with. Tyro actually integrates both those things together, and that explains a big part of its appeal for the moment. So it looks like it's built a better mousetrap, and it looks like it's very well managed. It's backed by really smart money. It really should succeed. There's no excuse not to succeed, but it looks as though it's priced for success as well, in my view. So it's probably one that we'd watch from the sidelines, and if something goes wrong, if there's some hiccup, and as we've seen, there almost always is, then this is one that we'll keep an eye on. So sit tight. We're watching Tyro. Unlikely to write it up, but we're watching it on the sidelines. Mickey, you love payments. Anything else to add? Even if it's just a spruik for your favorite stock?
No, there's not much to add there.
Surprised email didn't get a mention?
Oh,
I thought you
no,
may have slipped it in
that's
somewhere.
right. I think I've mentioned it enough
You
on this podcast.
You surely
so-
have. And
yeah.
in the office, you surely have, yes. All right. I'm hogging all the questions, but the other one that came through were a couple of requests for Caltex. So we've got a nice association with Caltex. You might not be aware of this, Mickey, but we recommended this stock back at about $14 or $15, maybe $16, when it was just a refinery business and no one really knew about the retail business. It then shut down its refinery and turned into a retailer and an importer of fuel, and the share price doubled. And after it doubled, we sold out. around $37, $38. It's now got a new strategy in retail, and we've written before that strategy isn't really working out, and so we ceased coverage of this stock, and we haven't really been covering it. And during that period, it's received a takeover offer. The takeover offer is for, I think it's $32 a share. It's a very chunky premium to its old price, and management is engaging with the bidder, which is an operating business out of Canada that wants to actually keep the operating sites and maybe expand or roll them up with other assets that they have. To me, the bid looks really attractive, and if I was a shareholder, I'd be tempted to sell into the bid. But these are really good managers, and I think there's a chance of actually extracting a higher price out of the bid. So it's probably a good idea just to hang tight. We have no plans to recommence coverage. To me, it looks like Caltex is going to be broken up and digested or sold wholly. So I think in a year from now, it's probably not going to exist in its current form. So it looks like it's the beginning of the end for Caltex. And I don't think the sale price will come close to the price that we actually sold it for, which was in the high 30s. So I think we've done pretty well out of this one. And it just shows that sometimes, there's this mantra that you don't sell easily or sell often, and sometimes prices do become attractive enough to sell. And so we shouldn't forget that selling at the right price is still the optimal strategy. Mickey, we've got a question which seems tailored to you. A member has asked about whether we've looked at water stocks. I know you are interested in water stocks, so you bought a couple to the Dragon's Den already. One,
Yeah.
but you've mentioned a couple already, and maybe you can talk about why water is attractive.
Yeah, well, I'm not entirely sure how I ended up getting painted with this
I know,
brush, but I
maybe
think
it's a
I
bit unfair.
probably brought it on myself. But yeah, the only major one that we really kind of brought to the Dragon's Den was Webster, and I think at the time it was interesting. We were taking a look at the water rights, which appeared to be getting overlooked within the overall structure. But I mean, obviously, given the drought and given the pressure that we have on kind of fresh water supplies all around the world at the moment, I forget the statistics, but I think it's something like 30% of the world is going to be short of fresh water. So it's about, getting and obviously we need water not just to drink it, but, for industry and for agriculture and lots of different things. So it's quite a big problem, and now there's lots of companies that are popping up to hopefully solve that problem. And so lots of technology and lots of innovation needs to go into that area. So there's a few ASX listed companies. I kind of had a brief look at a few of them, and there weren't that many that were kind of investment grade, I would say. There's a few that own the actual water rights themselves, and perhaps some of those kind of can be quite attractive assets. Particularly as the water becomes more scarce, having access to the regular rights to access that water can be quite valuable. So.
You mentioned one to me where the specific business model was to buy and trade water rights. So was it Drake's or something?
Duxton Water.
Duxton Water.
Yeah,
sorry,
that's right. So it's kind
That's
of like a listed investment company,
Right.
but they mostly focus on buying and selling water rights, and generating income from the water rights. It's I guess it's a little bit controversial because they're taking these water rights and then they're renting out the water allocations to farmers or whoever needs them, and they're generating income. But it's not clear if that's kind of how they were designed to operate in the first place.
So in my previous job, I used to price water. I was a model. Yep.
So
there
really,
go.
you
I was a
should be
model.
taking these questions.
Yeah. So I used to price water, and we used to work pretty closely with the regulator, and they were very unhappy about people profiteering from the water trading system. It's supposed to be a way of allocating water. So users of water can efficiently decide, who should get it and where it should go. It's not really designed as a source of profit in its own right. And I think if you're in the business of purely trading that for profit, I'm not convinced that there's a sustainable business doing that, because it will get crunched at some point, I think.
Yeah. Well, I mean, I just can't imagine like the regulator being okay with a company cornering the fresh water market.
Yeah.
because obviously it's pretty important resource, and so if one company's just kind of got control over that market, that could be quite serious. So so I'm sure that they're all looking into it. But yeah, in terms of what we found, nothing too interesting. I mean, it's but I think we were talking about this before the podcast. It's kind of you probably don't want to be looking at taking a sector-based approach or a top-down approach generally to uncover ideas. But you kind of, I suppose you want to be looking in areas where hopefully other people aren't, or areas that might be getting overlooked or something, or might be a bit beaten up. So, but seems like most people are probably across that space now, by the sounds of it.
Yeah, I mean, look, there are lots of ways to make money. I wouldn't say it's finding a theme and then trying to find stocks to fit that theme is an always a lost cause, but I haven't really found that a way to make money in the past. And it's not really the way we, as a team of analysts, operate here either. We would rarely find a theme, come up with a theme, and then find stocks to suit that theme. It's sort of not really our style. But they can be useful in as a filtering or a search tool. So if you think a part of the market is undervalued, or you think it's mispriced for some reason, you can look for stocks that fit that theme. But ultimately, the investment decision is really about price and value on a particular business. Remember, these aren't just bits of paper. You're actually buying a business, so you really want to investigate that business really closely.
Yeah, and like you don't ever need to go. I'm going to look at this sector. You can always just pick a stock and have a look at it, and probably gives you just as good a chance of finding something interesting, really. So
I think it can be easy to forget sometimes that as a business, your source of profit is really your competitor. Your competitor decides how much margin you have, and the amount of the amount of competition.
Don't forget the TAM.
Oh dear, yeah. We're sorry for those on the outside. The TAM is a total addressable market, and we're having a lot of inside jokes about how every stock is now talking about their TAM, even though it's completely irrelevant for a lot of businesses. Everyone's talking about their TAM. It's become a new valuation metric.
Nathan says price to TAM.
Price to TAM.
Price to TAM multiple.
Yeah. Where was I? Oh yeah. So the more capital that gets attracted to a sector, the more competition that gets attracted to a sector, the lower your likely returns. So, it can, although it's fun and exciting to be involved in these really sexy sectors, and water, believe it or not, I think is a really hot sector. Often the profit potential is minimized just because there's so much competition or capital attracted. Often I find it better to look at areas where there's not much capital going in, or no one's really interested. I think those are areas where excess returns can
I guess
be possible.
one example of that might have been a while ago with mortgage brokers, for example, during the Royal Commission.
That's
and
right.
you could see that all of them sold off, and now most of them have recovered quite strongly. So I guess if you can find areas where maybe you have a different view to the market, and so I guess.
So elegantly put. Yeah, so let's end it there. Okay.
So, yeah, I guess.
Very nice. Okay, well, if you have questions, you can send them through our regular Q&A, which you can access on the website. Do you know exactly how to do that, Mickey?
Yeah, so there's a Q&A button on the website.
Right,
and,
of course there is.
And you click on that, and submit
your
question.
So, all right, we better leave it there. Mickey, thanks for your time today.
All right, thanks, Gaurav.
For everyone else, thank you for listening.